Today I'm sitting down with Kieran, a pro trader from Darwinex Zero, to break down exactly how to trade expert advisors on the platform without getting correlated with every other trader. Sounds simple, but it's actually the number one reason traders lose allocation when trading with EAs. I've opened over 60 Darwinex Zero accounts chasing the answer myself, and now I'm getting it straight from someone inside the platform. By the end of the video, you will know exactly how to build a portfolio of strategies the risk engine actually rewards. But before I meet you with Kieran, take a moment to double check if you've subscribed to the channel, because our analytics show that most of you missed to do it. You keep watching my videos, listening to the podcast, but missed that simple one-click action, which is actually free but means a lot to us. So thank you for subscribing. Kieran, welcome to the podcast.
Thank you for having me on, Petko. It's a pleasure to be here, dude.
I am very proud to have this conversation exactly with you, because you are not just part of the Darwinex platform, but you're a trader yourself. And I know that you're trading Darwinex yourself. So all the answers will be from traders' point of view and not from platform's point of view.
It's a difficult balance to strike, because many of the conversations that I have with our traders, I have to preface that with, I understand exactly what you're asking and I understand what you want. So please don't take me as some corporate suit and tie, somebody who's just in business development, who's never lived and breathed the product. It's everything that our traders generally ask for. I'm a massive fan of as well, being a trader and using the software as such. So yeah, it's a great position to be in, because generally I don't have to kind of sell Darwinex Zero. I just talk about my experience with it, and that kind of does the job for me. So
okay, good to hear that. I'm pretty sure this will be useful for our subscribers. And I want to go really straight to the point, because the issue we are facing recently with Darwinex is the fact that once we share which EA we are trading, we immediately get correlated with others, because obviously many of the subscribers want to replicate what we're doing, which is understandable. I don't want to avoid that. And at the same time, I don't want to hide my accounts from the beginning. Since we started Algo trading space, we wanted really to be transparent with everybody, to review EAs transparently. So if one fails, it fails. The recent videos were all about failures, unfortunately, but it is what it is, right? And when we share profitability in Darwinex or withdrawals, immediately after that we get correlated. And that's something also our subscribers are worried about, because if they copy our EAs, they can't make money. So before you answer to that, can you explain what is the correlation actually for the beginners who are listening to the podcast? And then I'll be happy to hear your tips on how to avoid the correlation.
Correlation is widely misunderstood in the context of how we measure correlation for DarwinIA. Reason for that is correlation generally, when you're talking algorithmic trading or systematic trading and we talk about correlation, we're looking at asset to asset correlation or strategy to strategy correlation. Do they perform at the same time? Do they hedge each other out? And whilst we're looking at a similar kind of lens, we're looking at Darwin to Darwin and how they perform against each other. We don't look at individual trades. All we look at is your return and your drawdown, the same metrics that we use to calculate DarwinIA. So it's your previous 6 months return, previous 6 months drawdown. So what will happen is if you're trading the same strategy, it might take a couple of months to catch up, because if you've just gone through a 10% drawdown, I won't have inherited that drawdown by nature of starting a month after you, right? So already our correlation metrics are completely different, because you have a 10% drawdown, I don't. Then if we both make 5% in the next month, I have a 5% return, you're still down 5%. Does that sort of make sense?
Yep.
So, over a period of time, and it can take 5 or 6 months, the correlation will creep up and you will eventually become fully correlated with one another by nature of trading the same system, generating the same return, and going through the same drawdowns. Now,
does that mean if you are algo trader and use EAs, you have to change EAs from time to time? Or that's just for me because I'm sharing my results publicly and it's a good idea in my personal accounts to rotate the EAs?
The question really is, how do you want to do it? Because the correlation only applies to DarwinIA allocations. So if you have a permanent allocation, a booster, investor capital, if you're in index, none of that is measured through correlation. It's only for DarwinIA. So if you're performing really well and I don't know, maybe you bought a permanent allocation, maybe you had some boosters, or maybe an investor's backed your Darwin, none of that gets affected by being highly correlated with somebody else. It's only the monthly DarwinIA allocations. However, if you are correlated and you're excluded from DarwinIA, then any subscription fee for that month gets returned to you as a trader anyway.
I didn't know about that, to be honest.
Yeah.
I didn't know that.
A lot of people don't, but if you're excluded this month because of correlation, then yes, you should receive kind of credits back for the subscription payment for that month. We don't charge you for that month, essentially.
Okay, that's good to know. Yeah.
But what we have to ask ourselves, and it goes a little bit outside of the scope of the question, is Darwinex, as well as being this tech company that provides all this infrastructure to traders, as well as being a broker, is we're also an asset manager. And the asset management side of the business is now huge. And with that in mind, we have to think like a true allocator thinks. If you walk into a hedge fund, a prop desk, any sort of institutional or professional trading desk, what you will find is they have specialized pods. Okay. And those pods specialize in a certain area. And the reason that they do that is to diversify their streams. Now, we do it in a similar way, but of course it's a little bit more difficult because we have, 10,000 plus traders globally. So we can't just organize people into different pods within a room. So the correlation kind of, from our perspective, from a risk perspective as an asset manager, the correlation allows us to nurture these traders without us just providing excessive risk. Because if we allocate capital to every single trader who's taking, or not necessarily taking the same trades, but generating the same beta stream of return, then all we're doing is doubling, tripling, quadrupling our risk, but not really getting any more diversification. So that's the whole idea behind correlation. However, as I mentioned, we don't punish traders for being correlated. You can fall out of correlation. We don't charge you for that month of being correlated, and it only affects DarwinIA and nothing else.
These are two things I honestly didn't know, even though I've been with Darwinex for quite a long time now, but it's always something new to learn.
Same for me. There's always something new to learn.
And with the last podcast we did with Juan and his brother when I was in Madrid, I remember he said that from the investor's perspective, at this time there were around 150 strategies, what you say, trying to diversify. And I can't imagine how difficult it is to, really extract the best ones from the 10,000 users you have. Maybe we can get to that a little bit later, but is that number increasing continuously, or you're keeping this 150 or 200 strategies, and if I want to get into there, I have to replace somebody?
So we're over 200 now. This is purely for the index, which is our master fund. The issue that we're having now is capacity. We need to increase our capacity so that our flow is less toxic, meaning that we're getting better fills at higher size. That's not, well, it kind of is on the traders' end. Traders can do this themselves, but also we need to kind of increase our infrastructure. We need to get higher limits with our liquidity providers and all that sort of thing. So that's something that we're working on now. As that progresses, more traders will come into the index. But you're right. There's multiple different layers to it. So if we have, let's say we're taking a look at NASDAQ traders, we might take the top 20 NASDAQ traders. If you fall outside of that, you might be kind of reserve, right? Because again, all we're doing is we're going to be adding more exposure to the same asset. And as an asset manager, that's not the right way to go about it. As we increase our capacity, that will change and we will allow to bring more traders in. But generally, we haven't really had a problem with this in terms of there's loads of traders sitting on the sidelines where we're going, we wish we could give them money. We wish we could give them capital because, as you know, the success rate is fairly low for traders over a long period of time. So even when somebody has a promising record, we can't jump the gun too quickly because quite often they will blow up at some point. And then the second layer is if every trader in the index has a hypothetical stop loss. Okay, so effectively what we're doing in the index is we're trading traders. You know, if I take a look at Petko's Darwin and it's got a quote of 150, I will buy that quote of 150 and then hopefully the quote will go up. Okay. If it doesn't, if it goes down by 7.5%, that's where we hit stop loss. So effectively what I'm doing is I'm trading you as a trader. That's what the index is, or at least the most simple way to think about it.
Yeah, you explained it simply.
If Petko hits its stop loss, you would be removed from the index, not permanently. You can be bought back in. What we would do is an analysis on that, and we would go, okay, is this within the mean of Petko's performance? Is this something that we would expect? Are we happy to take the risk and buy the Darwin again? If the answer to all of those is yes, we will buy the Darwin again, and you'll be included in the fund. If not, we might go to the next reserve, or the next reserve, or the next reserve.
Can you explain the difference between to buy the fund, to be part of the fund, and to be backed by investors? Because first is the DarwinIA, right? And then you get allocation. And then you can get this capital from investors. Does this capital from investors guarantee your spot in the fund or not yet?
No. So from a trader's perspective, the fund is just another investor. It shows up like another investor on your dashboard. In fact, I can't. I was going to share my screen and show mine because I'm included in the index, but it has all the names of my investors, so I can't do that.
Okay, you better not.
Effectively, on your investor list, it will just show up as Darwinex Index and how much capital they've allocated to you. There's also an AMC certificate, which is an actively managed certificate, which is anybody invested in the index, but not through the Darwinex platform, through the AMC, which we don't have to get into now, but there's usually 2 investors of a similar amount. Okay. That is the index. So as a trader, it's no different. As an investor, all it does is instead of you coming to the platform and going, I need to make a diversified basket of investments here, and not financial advice, of course. And so I'm going to choose A, B, C Darwins. We go, listen, there's already an index managed on your behalf. You can allocate to that and not have to worry about it because we take a look at the diversification within. We do the monthly rotations of the Darwins. We handle everything for you as an investor. But as a trader, there's no difference.
Okay, I see the point. And because, as you know, I'm YouTubing my trading and I really want to help the subscribers to get into there. What is, according to your experience, the best way for a beginner to walk through this path? While in DarwinIA, they should combine a few strategies, EAs, to avoid correlation. And then once you are backed by investors' capital, you're a part of the fund, then it doesn't really matter as far as I understand.
Correct. I would say if your end goal is professional asset management, which I think a lot of people who get into trading, it is, although they don't know it. They just think, I'm going to scale my trading. All I need is more capital. But actually, there's a lot more that goes into that. You have to change the way you think, the way you act, your behavior, the way you approach the markets and everything. If that's your goal, then there's a lot of infrastructure changes that have to take place on the way. Now, the great thing is when you're trading with Darwinex Zero, is that becomes your training ground. Okay. A lot of people look at Darwinex or Zero and they go, this is where I'm going to start trading for capital. When in fact they should reframe the way that they approach that. And this is exactly what I did. This is my vehicle to learn how to go from a trader to an asset manager and act in a professional way. So if I look at my track record, I can remember the first few weeks because it was the first exposure that I had to systematic trading. I'd been a discretionary trader for many years before that. And so I just saw it as I don't have any goals or any predefined success criteria baked into this. I'm just going to learn as much as I can along the way. Ended up being really successful with it, but that's because I approached it with, I'm just going to learn. I don't care about the allocations. I don't care about the investor capital. I just want to develop as a trader. And so I really try to get that message to anybody who I speak to. And I know it's difficult because you know, we're asking for your trust and your money as a subscriber, but really that's what Zero is. It's a trader incubator for people who want to become the next level. They want to become a professional. Circle back to your original question. You said, you know, what should people do in the meantime with their correlation? So first of all, I think you have to have an element of being unique. This is just a general rule for becoming professional. You have to be slightly unique. That doesn't mean that you can't use the same strategies or similar ideas or anything like that. I'm not saying that you have to go and build your own everything. You could build a unique portfolio. You could, you know, and you can get AI to do this with you. You can go, here's 5 strategies I've had through Petko, for example. I'm going to put them into a master portfolio, but I'm going to adjust the risk. I might add a filter. I might offset the entries by X amount of pips or time, something to make you slightly unique. You might still be using the same ideas, but you're still unique. And then you want to learn different things like capacity. How am I going to scale? You know, we released a code for algorithmic traders to split their orders. Again, it's making them unique because they're able to handle more capital. So there's all these different things that you can do in the meantime to stop yourself from getting too heavily correlated. Because if you're using 5 strategies and I'm using 5 strategies, but only 2 overlap, our performance is going to be different. There'll still be probably a little bit of underlying correlation, but nothing to the point where we go, oh, they're just trading the same. Because I build all my strategies manually, but I take inspiration from a lot of other traders and a lot of, you know, published pieces about strategies that have been around for 30 years. I'll take that and I'll work an idea, but nothing's hindered me. It's all just using the same idea. So I wouldn't be too worried about, you know, Petko and your subscriber using a similar EA, as long as you're making it slightly unique.
I hear you very well, and probably I wanted to add 4 or 5 things, and I will just forget about it. But you know, when I started doing podcasts, I was taught that I have to listen instead of talking, and I wasn't used to listen. I used to talk a lot. But what I wanted to add to your suggestion is, and I've said that to many of our traders in the Discord, in the VIP, where we're having one-on-one calls, because they will grab a strategy, a proven EA with track record, and they just want to replicate it. And on Darwinex, they should make it different, right? And they will just play with the inputs, will change, for example, the grid distance multiplier, whatever. And I say, you know, don't try just to make it different, try to make it better, which aligns pretty much with what you said. You have to be unique. You have to add something special to that strategy. It doesn't matter if it's 1, if it's 5, if it's 10, not just trying to change it, but try to make it better. And as you say, with AI nowadays, it's super easy because you can drop a few strategies, you can add a filter, you can combine them into one master EA and trade it in a, not just in a different way, but in a better way than what Petko trades. right? That's very important, and I think I absolutely agree with you that people should try to be unique and not just to replicate. That's why I don't like copy trading, to be honest. Whenever people ask me about it, I say, don't ask me about it. I don't know. It doesn't matter. You're copying traders, ask them. I always have to try to be better, or to prove something in the whole process, right? In the whole game, you have to do something. And we're still in the first question I had for you, and I have a couple of more. So I would like to go for the next one, where I wanted to ask you, from the experience you have in Darwinex, what type of strategies work better nowadays? Scalpers, swing trading, grid martingales? I know that Darwinex engine doesn't really like the grid martingale strategies because they tend to go in a bigger floating losses, or they just make huge drawdowns rapidly and your ranking drops. What type of strategies people should chase before they sign up for Darwinex?
So there's no one that's superior to another in terms of scalper versus swing. Everybody is unique, and I've seen the best of the best and also the worst of the worst. Whilst I've been at Darwinex, the most consistent and most robust Darwins are generally multi-strat portfolios. So whether it's usually systematic, but 99% of the time it's algorithmic systematic. Multiple strategies all operating within the one portfolio, and it's not that they perform better, but it's that they are more robust over a longer period of time. So your subscribers are pretty much all algo traders, I would presume. You're in the perfect position to build a portfolio because you're probably building or taking a look at hundreds of different EAs over the course of each month. You can build portfolios quite fluidly and quite easily as long as the strategies are good at base level, right? It's funny you mentioned grid and martingale, because I generally am not a fan of grid and martingale because of past usage, years and years ago myself. So I have this this internal demon in my head. However, I figured out a way to generally get it working on Darwinex within a portfolio. So you're absolutely right. The reason that the risk engine doesn't like grid or martingales is because we measure your exposure. That is your true value at risk. Okay. So how many, what is your exposure to the market? It doesn't matter where your stop is. It doesn't matter how long you've been in the market, how much exposure do you have right now? And we use that as a baseline. Now, with grid and martingales, the further you go into drawdown, those strategies start adding more exposure. Now, the risk engine's job is to maintain and control that exposure. So they fight opposite battles. So what will happen is as your EA starts adding more exposure, the risk engine will start closing older exposure. So that's why you'll see this massive drop off on a grid or martingale EA on Darwinex, because your exposure gets closed. They fight different battles. Now, what's really interesting, and I ran this as a test for probably about 6 months just to try and help answer this question. I ran a grid strategy across multiple assets. I sort of ran it as a little bit of a portfolio within itself. I had it running on gold, a load of FX pairs, a couple of indices, but I also had a few breakout strategies running alongside that grid portfolio. What I did was I set the breakout strategies a fairly high risk in comparison to the grid portfolio. Now, the breakout strategies, they were good edges. Like they weren't just there just for the sake of being there. They were solid on their own. But what was happening was the risk engine was taking the highest size as our baseline risk. Okay, so when I was taking a breakout trade, my VAR might have been 15%. Now, when I was taking a trade on the grid system, my VAR might have been 1,000th of that. It might have been 0.01%. So what it was doing, the risk engine was never getting involved in my grid portfolio because it was always looking at my baseline risk, which was so much higher than what my grid portfolio was doing. So even if my grid was getting in a deep drawdown, the risk engine was never concerned because it had sized it accordingly to my breakout strategies. Does that make sense?
Yeah. That's very interesting.
So and that worked for a long period of time. The only caveat to that is I never saw a period where the grid kind of went haywire. Okay, so the reason I probably didn't see that was because I implemented a stop loss portfolio wide. So I let the individual positions work. And I did go through some deeper drawdowns, but they were kind of normal when considering the size of the breakouts. But all I would do is put a stop loss over that grid portfolio. So, you know, if your P&L exceeds $2,000 for an example, close the grid trades, didn't work, stop loss, move on. The next breakout trade might recover that anyway, and you start the grid again. So at least you get this kind of steady stream whilst you get the breakouts as well. And it's a really interesting concept because I managed to get it to work and to have the risk engine not intervening all the time.
Interesting approach. And what is the stop loss people should use if you're a beginner? Let's say you start a new Darwinex Zero account and you put a couple of EAs, or you trade manually, doesn't matter. If you go to negative 15, 20%, 30%, where they should cut it and say, oh, I'm restarting the account, or actually I'm changing the strategy to, you know, to regain or to break even at least. Where is the stop loss? Probably doesn't sound all right, but where is the stop loss for the risk engine?
Your Darwin will always be in a trade if your Signal account is in a trade. So it completely depends on the strategy that you're trading, to be honest. If it's a grid or martingale, I personally would cut the losers far sooner, purely because it's like a fine balance, right? We know that grid and martingales generally recover most of the time. So if you cut it at 20%, it's going to be really difficult to recover that drawdown. Whereas if you cut it at 5%, it might take you a few weeks to make that 5% back. So I would probably run an optimization and put a portfolio level stop at 1%, 2%, 3%, all the way to 20%. And I would see generally what works best. If I start implementing a 1% stop loss, you know, and not necessarily starting again, but, you know, then allowing the trades to recover. How does that look over the past 10 years if I was to do that? You know, if I was to do it 2%, how does it look? 5%, how does it look? 10%, and so on and so forth. But with grid and martingale, I would probably get in the habit of cutting it as early as possible. And you can do this by taking a look at a few metrics like your maximum adverse excursion. So you could look at, on average, how far do these trades move against me? You know, and if you find that your average excursion is 150 pips, that becomes your new stop loss, or at least 160 pips, 170 pips becomes your new stop loss, because generally what happens after 150 is it goes on a massive drawdown. It's fairly easy to take a look at and implement. And going back to my earlier point with things like Claude and Codex these days, you can get answers to these questions pretty fast. You know, you can hand it back tests and statements and just say, analyze this and kind of help me find the most optimal settings for X, Y, Z.
I also wanted to ask you a few things, if they matter or not for the Darwinex engine. Number one is the lot or the size we are trading, because people usually would increase the lot and the risk they're trading according to the size. So if they're trading a live account of, let's say, 5K and they open a Darwinex account, they would just increase the lot 20 times. And I usually say you don't need to do that, because the risk engine is there to put all the traders in the same risk tolerance or risk level. So does it really matter if you start trading a new strategy, if you start with 0.01 lot, if you're trading 2%, or if you're risking 5%? Does it really matter, or it's...
So there's 4 different things that influence the risk engine. Number 1 is the asset that you're trading and its inherent volatility. So of course, gold is higher in volatility than euro dollar, which would therefore inherit a higher risk or inherit a higher value at risk. The trade frequency, so the more often you trade, not necessarily higher the risk, but the more exposure you're taking to the market. Okay. Your trade duration, So how long you hold trades for. Again, it's not necessarily saying it's higher risk, but it's saying there's more exposure to the market yet.
Okay, yeah.
Fourth and final thing is your position sizing. So it takes all of those, but the real one that makes the biggest difference is your position sizing. Now, it doesn't matter what size you trade with because the risk engine will always adjust your size. So if you start with a 0.01 lot or a 1 lot, it doesn't matter because the risk engine will adjust to however you trade. Exactly. I always say it's easier to trade with the tiniest size possible because mentally you look at your Signal account and you're like, well, it is what it is. You know, my Signal account, for example, the size is really, really small. But then my Darwin is like 4.8 times multiplier. So my Darwin's heavily scaled up. And I prefer it like that because the numbers that I look at in my Signal account. So yeah, I would say just trade with a smaller size as possible and just let the risk engine do its thing. And don't decide to change it halfway, you know, because the worst thing that people do is they'll say, I want my risk multiplier to be 1-to-1. Or 1x. And I'm like, there's no benefit in doing that. There's no reason to have that. And they'll say, yeah, but I want to. And I'm like, well, okay, but if you increase your size massively now, the risk engine's going to take a month or so to catch up with what you're doing now. So it can really harm you in the short term. So I just say start as you mean to go on. And generally I find it easier to trade smaller size.
I will just share my screen quickly for the people who are watching the podcasts, and we will show this to the people because I do believe it's important. So with this account, I have a small allocation here of 30,000, but this is where we are pretty much testing new EAs that we created ourselves. We got allocation, it was reduced a little bit. Now there is a little bit more reduced again. But the point here is you're talking about this Darwinex risk, right? Where at the time in my Signal account, there are trades with Euro Yen, could be one, could be a few, with 0.5 lots. But because Darwinex, and correct me if I'm wrong here, but because Darwinex takes this to be a low risk trading, let's say there's no grid Martingale, anything like that, it multiplies by 5.28. So I get a position of 2 lots is 64 in my Darwin. Is that correct?
That's correct.
Yeah. So there at the beginning, we were trying to figure that out, how to make it equal. But then I figured it out that it has to be equal, right? It doesn't matter for the risk engine. And what I remember from the podcast with Juan was that as long as you trade it equally, or as long as you don't change the risk in the middle of the way, as you said, the better, right? We shouldn't change risk trying to catch up or to recover the losses. The risk engine does that.
Yeah. And, you know, that's not saying that you have to trade, like you said, you had 0.5 lots open. It's not to say that every trade has to have 0.5 lots. There can, of course, be some slight variance, but you can't go from 0.5 lots to 5 lots to back down to 0.5 to back up to 5. Because, you know, that, for example, is like a 10x in size. So it's like 1,000% increase in risk.
And it shows inconsistency, right?
Exactly.
Inconsistency.
Yeah.
Okay, I'm glad that you've shared the 4 important things. I will ask my editors to display it next to me one more time, so people will remember. But does it matter the time frame you are trading and the assets? You answered the second one. The assets matter because of their volatility, but the time frame of the strategy, is it taken into consideration or not?
That's not data that the risk engine would be able to determine, because it only sees base level trade data. It won't say, oh, this was executed on a weekly chart. However, it kind of goes hand in hand subliminally with the trade duration.
Exactly.
Feature.
Because the lower the time frame is, you're expected to exit faster.
Yeah. But then on the flip side to that, you also have trade frequency. So generally what you see is the lower the frequency, the higher the duration. Generally. Not always, but that's kind of the pattern that you see. But I always say the asset, the frequency and the duration pale in comparison to the position size, because you could be trading euro dollar one trade a month, and you could hold it for 10 minutes. So when we look at your exposure, it's absolutely tiny. And we go, well, this guy takes no risk at all. But if you're doing that with 1,000 lots, it doesn't matter the asset that you're trading or how long you hold it, you've just taken 1,000 lots. And on the flip side, we could go, well, this guy trades, Bitcoin or gold or something that's a lot more volatile. He takes 1 million trades every month and he holds them, for 2 months, but he's doing it with the tiniest size. So he gets away with it. So position sized for me is massive compared to the other three.
Okay, so to put some kind of conclusion here for myself and for the subscribers, from everything you said, is it better or recommended to trade not volatile assets in and out quickly with small lots, right? So let's say scalping strategy on an exotic pair.
Don't let any of the risk engine influence your trading decisions. Don't fall down that rabbit hole. The three I mentioned, the assets, the duration, and the assets, the duration, and the frequency, those three are strategy specific things. Don't change those. If you have a strategy that works on a specific pair or asset, or if you have to hold trades because that's your expectancy, it needs you to hold trades for a long period of time, don't change it. If you want to change your exposure, tweak the risk, bring the risk down or slightly increase the risk. Don't ever, and this is coming from a trader, right? Don't change your strategy to satisfy the risk engine.
Yeah, that makes sense. That makes sense. Though in my eyes, probably I see it a little bit different way, because now we have access to nearly all the EAs on the market, and we trade many, and obviously we can't have hundreds of Darwinex accounts. We have couple. When I say couple, probably I've opened over 60 or 70 accounts along the years to test and to experiment. And if I, let's say, want to open one new Darwinex Zero account every month, I will have to pick between a few different EAs to put in there. So I'd like to know what is most suitable for the risk engine. But I get your point. Traders shouldn't change their strategy to satisfy the engine. Yeah, that makes absolute sense to me.
Yeah. The only thing that will affect you with that is if you're trading exotic pairs, you'll generally have a lower capacity, which means you'll be able to take on less capital in the future. But as I mentioned earlier, there's things that we've released and built. I actually built an order splitter, which splits your trades into multiple orders. And then our quant Marty from Darwinex Labs, he enhanced it and released it on his GitHub. So anybody listening to this can access that. So if they find that they have an issue with their capacity and that their capacity is really low, they could implement our order splitter from Darwinex and would increase that. But that's the only kind of issue I would see from an asset perspective.
Okay, yeah, that makes sense. Okay, and you've mentioned a couple of times portfolio, something I've been talking a lot in my videos. What does the genuinely uncorrelated EA portfolio, or not EA, but portfolio strategies looks like from the platform side? Like, again, if you're a beginner and you want to succeed in Darwinex Zero to receive the allocation and everything, what should you be trading? For example, euro, dollar, gold, USD, how people should diversify their portfolio, not just to satisfy the engine, but to build this uncorrelated portfolio that will do well in the long term.
So generally, assets are going to be fairly uncorrelated anyway, meaning that they'll fire off trades most of the time, at different times. Of course, there's going to be exceptions to that. If you trade through news events, then yeah, you might, after a shock NFP, get tagged on a few different strategies. The main thing is to find out where the worst trade clusters happen. So if you run backtests and if you import them into Quant Analyzer, for example, and then you run a correlation test across the strategies, you can see, okay, which strategies generally fire off frequently at the same time. If you want a diversified portfolio, you want really low numbers there, because you might build 10 strategies on dollar yen like I did in the past, and they're all fantastic and they all work great. And you go, oh, I've got this diversified portfolio. But then when Trump comes out and says that the Strait of Hormuz is closed and they all fire off simultaneously, and now I'm in $10 yen longs, you go, oh, actually, well, I wasn't that diversified, was I? Because the trade clustering all happens at once. So the things that I check for is, do my strategies open trades on the same day, in the same hour, and on the same week? Do they close trades on the same day, hour, and week? If I can confidently say that there's little overlap, that's what a true diversified portfolio will look like.
Yeah, I get your point. We are doing this recently with AI a lot. Like we just drop the back tests of different EAs and assets on AI. We just tell us if the drawdowns happen at the same time or not, if they're opening trades at the same time or not. That's very important. And when I said back tests, I left it for the end, but I really want to ask you about the Darwinex Zero data, which I believe is the same as Darwinex data, because recently we were building this in-house product, and probably this will be the first time I show it in the videos, and I will share it with you as well. It's a software that we've built to run simultaneously multiple back tests. Pretty much we can drop in there, let's say 5 EAs with different set files, and we can back test on multiple assets, on multiple time frames. There is nothing like that on the market, and it took us a lot of time to build it. Still, for us, the team of Algo Trading Space, maybe we will add it to some beta traders in the Discord. Maybe we'll open it for the public, but it uses pretty expensive hardware. As you know, all of this hardware nowadays is expensive. But what we figured out was that the Darwinex data, especially the every tick data, is just 100% real tick quality, and it's free out there. And I have one of my MetaTraders here on the computer installed all the time. It's opened all the time, and I backtest EAs all the time, and the data is just great. So why do you guys provide such a good historical data? That's really very important for the algo traders.
As I mentioned, the asset management side of Darwinex is massive. And we set out a goal many years ago to find the best traders out there. More recently, that goal has changed to find the best traders and build them into the best asset managers. So we have to give everybody the best quality tools that we possibly can, and everything that they would need to be able to become that asset manager. There's no point in testing on data that's absolute awful and getting, results that say a strategy is great, but as soon as they deploy it onto real tick data, it just gets absolutely shredded apart. So that's one of the reasons that we are so passionate about putting things out there that will genuinely help people. Again, like the order splitter that we built, that's out there. It's proprietary to us, but people can use it freely. The tick data, again, it's proprietary to us, but people can use it freely. I would say before pre-2017, 2018, the data falls off. So from 2018 onwards is generally where the data is absolutely spot on.
Which is good enough. This is 8 years of data. Most brokers don't provide even 5 years or 3 years. Even some of the big names I don't want to mention, but they claim to be the number one in algo trading, and they don't have historical data, which is ridiculous. And we were really comparing dozens of brokers' data, and Darwinex turned out to be the best one. And we will probably use it as the default data source in the app, in the software, because that's really, really important. And some of the strategies are really data sensitive, spread sensitive, or tick sensitive, if you want to call it. And that's really nice. I'm really happy. Well, the whole team is happy with the Darwinex data. And I'd like to thank you for providing this data. And I hope it never pauses, because it's something I remember the old days when I started with algo trading way before 2018, and brokers didn't have the habit to keep data on their servers, so we had to collect it manually, and probably you've done that as well, and we've been exporting it to text files, and we were collecting month by month to build at least 1 year.
Yeah,
they're huge. They're huge. They're huge.
I think my whole hard drive in my PC is just tick data. It's like the amount of tick data I have stored on my computer is insane.
Yeah, absolutely. And at the end of the day, there is a great data on Darwinex once you install the platform and you log into the live server. Oh, the other thing I really wanted to point out, without really trying to promote Darwinex, is the fact that the server where we are trading in our DarwinIA account, which is virtual money, we've clarified that in the previous podcast, so no need to do that. It's a virtual money once you subscribe, but it's a live trading environment, which gives you a real feeling of the live trading. And quite often our subscribers share that they don't have capital to trade new strategies or to test new strategies, and we just tell them go for Darwinex. It's €45 a month and you can test on live trading environment, and it's 100k virtual money but on a live server, which is just absolutely game changer for us, because in some of our Darwinex accounts we are just testing many EAs how they will perform live, which none of the other brokers offer it, right? They have demo or live, and usually they are different. And I've shown that so many times, and people are like, oh, why I'm testing on demo when if I go to live, it's going to be different. Well, it is what it is, right? And with Darwinex Live, these are the two things that kept me as an algo trader for good with Darwinex. The historical data and the live environment for a cheap price allows us to test so many EAs. It's very important. And for the traders we have in the Discord, when they share their portfolios, usually they will have a couple of accounts with that broker, with second, third, funded accounts, props, Darwinex. I always tell them you need to have this one Darwinex account where you don't want to make money from it, you just want to test all of your EAs in there. And if they backtest well, if they are profitable in there, you can trade them anywhere, but because you are actually testing on a live environment. And everybody can take one Darwinex account as a demo on a live environment where you can test and backtest whatever you want, basically whatever you want, as much as you want, because it's 100k capital, which allows us to put sometimes many EAs, right? Mm-hmm. That's been very algo oriented, if that sounds okay in English.
Yeah, I agree with you. So I also have my main Darwin, which is kind of my baby, and then I have a few different testing Darwins where if I'm going to deploy something to the main Darwin, it will get tested on because it's the same data as well. I need to know how close is it to when I set it live to XAQP. Is it going to be, the same? So I do that absolutely. And I think this is also a conversation that I've had with many other people is, in fact, Blaine, who now works with me at Darwinex, but he owns the Darwin IME. He used to put, £5,000-10,000 into an account just to test the strategy he'd built before moving it to his portfolio. And I remember having the conversation with him, and I said, why on earth you do it? Like, why would you do that when you could, just sign up to Zero, not to sell it to you, like, because this was before he worked with us. So not to sell it to you, but just genuinely, if you're running multiple strategies, you're going to need certain margin requirements. Otherwise, you're going to take too much risk. So that solves that. You don't know, and he's building strategies manually. So he is not only just performance testing, but also security testing. You don't know that as soon as you load that EA, it's not going to fire off 1 million trades at once, because you might have missed something in the build. Yeah. You don't want that happening on live. If you put 10K into a broker and then all of a sudden it's 5K, then it's 2K, then it's 1K, and you're like, oh my God, I shouldn't have done that. Do it at Zero. There's no risk outside of the subscription payment, So yeah, not to sound salesy, or you should definitely have Zero, but it's genuinely algo trader to algo trader. It's such a great play environment as well as it is somewhere to scale.
Absolutely agree to that. And I wanted to ask you 5 rapid fire questions at the end, which I always ask at the end of my podcast. And you can answer just with 1-2 words, just for the people that always hesitate between one of the two. So based on your experience as a trader, do you prefer MetaTrader 4 or MetaTrader 5?
MetaTrader 5, it's no contest.
Greedy EAs or scalping EAs?
Scalping EA.
Trend following EAs or swing trading for lower correlation?
Trend following with intraday closing.
Okay, that's interesting. One asset that traders should avoid nowadays? That's a hard one.
Silver.
Oh, okay. Silver is my pain.
Silver is my favorite asset to trade, but because I love trading it, I know how difficult it is. And there's a lot of security issues with silver because it's not as liquid as gold. So if you get bad broker conditions on silver, it can wipe your account.
You actually gave an excellent answer. Yeah, that was an excellent answer. Silver was the asset that blew my last manual trading account. And that was the point where I said, okay, I'm going for algo trading 100%. I've shared it in one of the videos. I still remember it. Kieran, I really want to thank you very much for the honesty you showed in this podcast, for the tips as a trader, and for not trying to sell Darwinex, but showing its pros, which are a lot, especially when you are an algo trader. I love the platform. I've been trading long there. I have opened so many accounts. At one point, it was overwhelming, to be honest with you. I had like 20 Darwinex Zero accounts, to be honest. It was just so hard. So now I reduced. So if you see my subscriptions going down, it's not because I want to trade less Darwinex. It's just because I'm trying to simplify it all, you know, and we are trying to build more portfolios into one account, which is the right way to go with live trading, with funded trading, with Darwinex, and you supported the idea of portfolios, and I really want to thank you for that. And I hope it's not going to be our last podcast.
No, absolutely not. I mean, it's been a pleasure to come on. We probably should have done this months ago, if not, years ago. You know me, dude. I'm always here. I'm always open to have chats about algo trading. So yeah, thank you for having me on, and I'm sure we will do another one soon.
Thank you. If the subscribers want it, we will do another one for sure. Thank you and have a wonderful day.
Thank you very much, Petko.
Cheers.